Hi, this is Dean Hoffman, and I want to thank you for taking the time to check out this short presentation today, not only on why you should be trading futures, but why I feel you should be trading them here at my firm, R Quant. And let's just jump right straight into it. First of all, I do want to say that commodity trading does carry risks and should only be considered by individuals who can afford the loss of some, all, or more of their investment. And we will be talking about some hypothetical performances, and you will want to check out the hypothetical risk disclosures on those. Right to the point of futures trading, why is it that we should consider trading futures? You've got the equity markets that have been shooting higher. You've got other investment classes. What is it about futures that gives them their special or unique flavor that makes them something that should be part of anyone's portfolio mix? I believe that probably the strongest reason or basis to add futures to a portfolio has to do with one related to correlation or a lack of correlation. When you're trying to balance a portfolio, one of the most important things that you need to do is make sure that the asset classes are not highly correlated. You could have 100 different stocks, yet if the stock market goes down, that might only mean that you're going to lose money 100 different ways. It's kind of like the old saying about a rising tide is going to raise all ships, and a falling tide is also going to drop all ships. So what becomes the real challenge is finding investment classes that are truly not correlated to one another. And it's virtually impossible to find any that are completely uncorrelated, but you do the best that you can. And time has shown repeatedly that the futures markets tend to have a relatively low correlation to traditional stock, bond, equity markets. And by adding that type of zig to the zag that you can get in the marketplace, those sorts of counter movements can help smooth out your equity curve and enhance your futures growth. The other attributes of a good asset class would include things such as a highly regulated market, which of course we do have with futures. It's a mature market. We've got a centralized exchange. And by having a centralized exchange, that means you've got instant price transparency. You have the same price everybody else does at the same moment everybody else has got it. You've got liquidity. All the buyers, all the sellers are gathered and accumulated in the exact same place. So when it comes time to get out, unlike, let's say, a piece of real estate where it might take months if you're lucky, you've got an instant buyer and seller pool. Now, of course, there's no guarantees. There can be slippage in there, but it's as close as you're going to get when you've got a centralized exchange. Most of these markets are now 24 hours. Some of them aren't. A few of them take a break over the weekend, but for the most part, most of the markets we're trading are now 24-hour markets with liquidity around the clock. One of the unique aspects of futures is the amount of leverage or margin that it offers an investor, and that can be a double-edged sword. Leverage is something that can be used for tremendous gain. Leverage is also something that can be used to generate tremendous losses. So it's a dual-edged sword, and we'll get into that a little bit more in just a little bit. And as a data person or scientist, one of the things that I particularly like about futures is that it has got an unparalleled amount of clean historical data. When it comes to developing any kind of systematic trading where you need historical data, you just simply don't have the kind of consistent, clean, time series analysis going back as far in history as you do with futures. You do have it with some equities also, so it makes it a very nice platform from which to do trading systems and statistical analysis and that sort of thing. The problem, I believe, with futures and why it might have gotten a bad rap over the years is from this guy here, who we're going to call Mr. Leverage. And just as I talked about earlier, leverage is something that can be used as a double-edged sword. Most futures contracts only require about 2 to 3% of their contract value to be put up, which means that a very small amount of money can leverage a very large amount of a commodity. And you put up just a small good faith amount of margin on that investment. And again, that can go both ways. I believe it is, in my opinion, it is that excessive leverage that has given futures a black eye in some regards. Maybe deserved, maybe not deserved. I believe that the four biggest mistakes in trading futures are having a lack of a trading plan and using too much of that leverage, failing to control the risk that comes along with that leverage, and then a lack of discipline. So what I would like to talk about, the upside of all of this, is the solution. And the solution, number one, is to only use risk capital. Futures trading is speculative, period. So I don't want to get past that. Once we've established that is a basic fundamental caveat to trading, I then want to move to what it is that we do here at R Quant, and specifically the relativity trading system that I have developed as a tool to assist investors with their risk management and decision making to trade the markets. And this is something that is done on a basis of historical, statistical back testing to help try and give us a proof of concept of what we're doing.